If you're a trader, you have heard this a million times. You've got to master your emotions. But what if that's not the whole story? What if the secret to success isn't just about staying calm? And what if, sometimes, being too calm could actually cost you money? Yeah, let's get into it.
So, you got to start with the legend himself, Mark Douglas. His whole philosophy, the thing he's famous for, is this idea right here. The real fight isn't with the market, it's not with the charts, it's right between your ears. Your own psychology is what makes or breaks you.
And this 80-20 rule, it just nails the point home. Douglas basically said that success in trading is 80% psychology and only 20% strategy. But think about it. Most traders do the exact opposite, right? They spend all their time chasing the holy grail strategy and almost zero time actually working on their mindset.
Okay, so if we all agree psychology is the big kahuna, how are you actually supposed to master it? Well, the conventional wisdom is built on a few core ideas, all designed to give you a rock-solid mental game.
And at the heart of it are these 5 fundamental truths. The goal is to really truly burn these into your brain, because when you do, you build what Douglas called a probability-based mindset. You stop trying to be right on every trade, and you just start thinking in probabilities. You accept that literally anything can happen, and that frees you from getting emotionally wrecked by every single win or loss.
So really, the end game here is simple. Build the discipline to control those 2 huge emotions, fear and greed. If you can do that, you can stick to your plan without freaking out. And that, we're told, is the golden ticket to making money in the markets.
Okay, but here's where the plot thickens. This is where things get really, really interesting, because some recent research has uncovered a major twist in this whole story.
What if developing that super calm Zen-like mindset? What if it's not a superpower all the time? What if it actually has a hidden, unexpected downside that can hurt your trading?
And this isn't just a theory. This comes from a super rigorous experiment. Researchers used a randomized controlled trial. This is the gold standard for scientific proof, to see what really happens when you train traders to be more mindful. And the result? Whoa. Just look at that number. In a specific type of market, the traders who got the mindfulness training, they actually did worse. A lot worse. They underperformed by a staggering 35.4% after getting bad news. Losing by almost 36%? That's huge. So you have to ask yourself, how on earth could being more mindful make you a worse trader? It sounds completely backward, but there's a fascinating reason why. First off, let's be clear about what they were testing. This wasn't just, do a quick meditation before the opening bell. We're talking about trained mindfulness. These traders went through 4 hours of practice over 10 days. The point was to develop a deep, lasting state of mindfulness. And this underperformance only happened in a very specific environment. The study called it the low uncertainty scenario. Now, I know, the name sounds weird because looking at this chart, it was anything but calm. Low uncertainty actually meant a ton of news was hitting the wire constantly. Good news, bad news, you name it. It was complete information overload.
So here's the aha moment from the researchers. The whole point of mindfulness is to put a little space, a pause, between something happening and how you react to it. It's meant to soften your negative emotions, but in a crazy, fast market getting hit with bad news, that pause turns into a very expensive delay. By reacting slower to bad news, these traders just stayed in a losing trade for longer, watching their money disappear.
And look, you don't have to take my word for it. This study's authors put it perfectly right here. Mindfulness dialed down the feeling of negativity, which is great, except it also slowed down their reaction time when they needed to be fast. And that, right there, is what crushed their performance. So where does that leave us? We've got this classic wisdom from Mark Douglas saying it's all in your head, and then this bombshell study showing that a key mental tool can actually blow up in your face. We need to put these 2 ideas together.
This really breaks it down. The old wisdom on the left says always control your emotions. But the new, more nuanced reality is that sometimes a slow reaction is a huge liability. We're told to avoid being impulsive, but it turns out a rapid reaction can be exactly what you need. And the idea that more mindfulness is always better, well, that's just not true. Its benefit completely depends on the situation.
And this all points to something pretty profound. Maybe the ultimate skill for a trader isn't just emotional control. Maybe it's contextual awareness. It's about developing the wisdom to know when the market is calling for a calm, reflective approach and when it's screaming for a fast, decisive, reactive one.
So I'll leave you with this question to chew on. Is the ultimate trading skill really about emotional control, the way we've always been taught?
Or is it about the ability to instantly switch to rapid reaction when things get crazy? The real answer, it seems, is knowing how and when to master both.